Eirik, thank you so much for taking the time and welcome to the show.
Thank you.
I know it's always busy days at Pareto, but is it safe to say that it's more busy than ever?
I mean, as you say, it's usually kind of busy, but I think this year there's a certain. I must say I'm a little bit more exhausted maybe because it's so volatile these days, and that's the challenge, right? That things that happen and have an impact on markets and share prices, and especially shipping equities. They can have one impact in the morning, and then you have a complete U-turn in the afternoon, and you don't really know what's changed, right? It's just so this world of tweets and rumors and trying to dig up the kind of marginal information, it's impacting and creating this volatility that is making us busy, keeping us busy, which is good, but obviously also a little bit. Yeah, I must say there's a certain fatigue, which is I'm not sure it's good, but it's at least keeping us busy. Yeah.
Makes perfect sense. So I thought before diving into segments to sort of paint the picture a bit more broadly, I think you have been vocal several times that shipping markets has been fantastic if you look at maybe the last 4 or 5 years, but it looks like we're entering to a bit more of a selective market. Maybe the downside has also increased a bit in some segments. How can you frame it in for investors and audience tuning in, the things that we sort of have behind us and what that taught us, and also what we're looking at ahead?
Well, I mean, of course, we had this black swan in 2020, which what 2020 did was, with the exception of crude oil, so tankers, the COVID really postponed demand. So in the wake of COVID, you had for dry bulk, you had for car carriers, you had suddenly some pent-up demand that needed to be satisfied. And during COVID, obviously, also you had a lot of scrapping. So 2020, 2021, basically all segments, even tankers, dry bulk, you had a lot of scrapping activity, and no one ordered, of course. So you came out of COVID with a kind of boost to demand, with the exception of tankers, and a very modest supply situation, very little fleet growth going into 2021, 2022. And then when you had this geopolitical shock from Ukraine, Russia, boosting demand, especially for tankers, I must say there's been a lot of focus on tankers in recent years, obviously. Then that kind of created a backdrop that has been, of course, fantastic, but not only for tankers, for as you say, many markets. I mean, we've created in some of these companies, if you think about the car carriers, if you think about some of these tanker names, you've actually been able to create sort of generational wealth. It's funny to think about how 5 years ago, I remember very well, 5 years ago, you had UK hedge funds that wanted to short Ocean Yield, which was listed in Oslo at the time, because they were so afraid of Ocean Yield's exposure to MSC. So they thought MSC, because of COVID, was going to go bankrupt. Fast forward 2 years, the owner of MSC is one of the wealthiest men in the world. It's amazing when you think about it. But yeah, no. So we're coming from 2, 3, maybe 4 years of great markets. Of course, what that does, it does boost order books. When you make a lot of money, you pay down all your debt. What do? Yes, you can start investing in other stuff, but why don't you just order a few vessels? And that's what's happening and has happened essentially. And then when you add, it's a very, very classic shipping cycle, because you have good times, boosting order books, and then suddenly you have something a little bit dodgy, a little bit uncertain on the demand side, which of course is what we all know now, tariffs, geopolitical normalization maybe, trade war, will that create a full-blown recession globally? Who knows? And that is where we are at the moment, right? So I mean, economics or finance 101 tells you that you don't really invest in super cyclical stocks when we're heading into recession. You never buy energy, but you certainly don't buy shipping, and that's a little bit where we are. So there are certain factors that would suggest that this is going to be fine for some sectors. Some sectors obviously look challenged, but are still doing quite well. But I think it's important then to emphasize, at least I'm a investor. I'm focusing on equities more than assets. I like assets, of course. That's why I do this. But I'm thinking trying at least to think like an equity investor. And of course, you have to remember that these companies that we are investing in, they are in a very, very different shape, which is why, the start to the second half of 24 and the start to 25 is a bit puzzling, because you have all these share prices falling 20, 25%, 30%. Some of them are down 50, 60% from peak. And these are essentially almost like enterprise value declines. I mean, historically, shipping companies have been 50, 60% levered. They order vessels, they have remaining capex. So when the cycle turns, they have 60% leverage plus a lot of remaining capex. Today, you have companies with 15, 20% leverage, no remaining capex. So when their share prices are down 40, 50%, then that means enterprise value is down 30, 40%, which is a lot. You're pricing in a lot of misery at the moment, maybe rightfully, but it's at least harsh. The market is kind of always, you're always guilty until proven, the opposite, right? And that's where we are.
Totally. So to simplify it, maybe a bit too much, is it more about today finding the good house in some sketchy neighborhoods? To use that analogy?
Yeah, but I mean, I wouldn't say neighborhoods are that sketchy. I mean, I'm trying to. I sit down in the evening. I go into my Excel models, and then I'm trying to become super bearish on, the supply situation. Look at all these new builds, and yes, in containers, in car carriers, you should be death scared about the new order book. I mean, it's not going to end well. It can't really end well. But in tankers, is it that bad? I'm not so sure. But of course, the market doesn't care what really. But so I wouldn't say the neighborhoods are too dodgy or too, there are certainly good houses out there. That's for sure.
But you touched upon containers. You should be scared, you said. Yeah. Is it as easy to pair it with recession, tariffs? I mean, there's a lot of things to unpack here.
There are, and I think number one is, of course, where was the market a year ago, or 15 months ago? It was heading into pretty difficult times. Rates were really falling, and then you had the Red Sea event, right? And the Red Sea has boosted TU demand by 10, 11, 12%, something like that. So there is a the market has been boosted tremendously by something that might continue. It might last for a long time. We don't know. But it's unlikely to be there 2-3 years from now. I mean, let's hope not. So of course, when you have that type of, in a way, artificial demand, we knew where the markets were before that event happened. This is going to normalize, and we're already seeing it, right? So adding then tariffs, the markets have certainly also been boosted by kind of pre-tariff buying. So when you add the order book on top of that, it's really hard, and I don't think it really matters for the companies. And this is where the distinguishing between thinking as a management team, as a company, as a family, and the more short-term oriented equity investors. I don't really see the appeal of being invested in container equities for the next 6 to 12 months. And if you're a fund manager thinking, okay, how do I outperform the broader market? I wouldn't look at containers, but from in a 5-10 year time span, these companies have created a lot of value, and they are in a great shape, and they will be able to, exploit markets if opportunities arise. but rates are going to go down. Rates are falling. They're going to go down further, and it's very hard to see 2025 be any better than 2024. And it's which of course was a good year, but it's very hard to see 2026 be better than 25. At some point, and of course the liner business, the container business is a funny industry in the sense that you have a very consolidated market. You have companies that are able to, in a way, adapt their fleets and their capacity in a way that you can't do in tankers, in bulkers. So you might not see a full kind of return to 2016, 17, 14 levels. But we're in for weaker earnings, for sure.
Do you distinguish then the big players versus MPCC?
Yeah, because the tonnage providers, they are as an MSC, as a Maersk, of course, the one thing you need to avoid is being short tonnage, and there's so much uncertainty, there's so much volatility, you don't really know. So of course you strive to have a little bit too much capacity rather than too little. It's very expensive to have too little capacity, and to pay, if you pay MPCC 20,000 or 18,000 or 27,000, it doesn't really matter at all. Of course, the guy who's responsible, he will care, but in a way, in the broader scheme of things, it's much more expensive to be without tonnage than to pay a little bit too much. So that's why the feeder market is perhaps looking more interesting. Order books are, and of course you will have this cascading effect, but it's mainly in the bigger, and I don't think there's a direct link between a 20,000 TEU and a 2,000 TEU. Of course, the 20,000 will trickle down to the Panamax segment, but maybe not further down. So MPCC could do fine. I mean, and they have backlog and pricing is modest, etc. So they're selling vessels, they're chartering out at good levels. So that market is perhaps stronger than you would think, and likely to stay so. But for the bigger names, I mean, it's hard not to see just this massive boost in capacity coming, and potential reversion of these demand boosting factors. It's hard not to see that, reducing economics for the big players.
If we take a segue over to the car carriers, and correct me if I'm wrong, but I've seen that you're quite optimistic on that sector. And I don't know if that's a contrarian view or it's just dependent on the companies and backlog and things coming out.
I think we're a little bit selective. We really like Wallenius Wilhelmsen. I think that's I think the Wilhelmsen family should take that company private. I don't think they will do it necessarily, but I think it would make sense for them to just take it private and avoid all the comments from analysts like myself blaming them for not doing this and doing that, and just avoid the hassle. Take it private. They've generated again. I mean, they paid $1 billion of dividends for last, or 10. I mean, it's exceptional. The economics and the cash flows they're generating. It's 80% cash conversion from EBITDA. Fantastic situation, but of course rates are coming down. So we're more neutral on Höegh. It's hard to be overly bearish on a company that is still trading at 2-3 times EBITDA, essentially debt free. Again, a company that was in trouble 4 or 5 years ago. But of course, the thing is, it's quite interesting because you have two companies that have been navigating through an upcycle in two different ways. Halto, they were chasing the top dollar. They did that beautifully. Investors that got in early have made 10 times the money almost, including dividends, or at least at some point they had. And now they're seeing that maybe reverse a little bit and struggle a little bit because they more short-term contracts, they have more spot cargo. Wallenius Wilhelmsen was kind of a slower moving animal. They had their long-term contracts, long-term relations. They didn't go from, charging clients $40 to $70 overnight. So it's been slower, it's been taking longer, but now they're there. And of course, then as well, you have a company 10,000 employees. It's a big logistics company, long-term relationships. I don't think they will see massive contract rearrangements as the market is, now scared of. I don't think they will do stupid things with their, $1.5 billion cash position. So I just think then from a valuation perspective, even though I understand the momentum and I understand that estimates might be peaking, it's just again hard to say, okay, it's a company with 10,000 employees trading at 2.5 times EBITDA. The debt levels are down by $2 billion from where it has been. They can pay out more. Maybe they should pay out more. But then it's just from a fundamental perspective. And that's, of course, the challenge of being a shipping equity analyst versus a normal equity analyst. It's different. It's a bit different perspective often.
Yeah, I think that was exactly the point in an interview I heard. Lasse Kristoffersen, the CEO of Wallenius, said that he didn't really want the volatile shipping label on his company because he said this is more like a logistical company. Maybe just emphasizing your point. But when you're also talking about taking it private, in that argument, do you have that holding company in that argument as well? Because that always seems to, get people going and discussions going.
Yeah, no, you have the holding company at the 50% discount to NAV, right? So does it make sense to keep it there? But I mean, VVI is they're doing their stuff, so that company can remain listed. But maybe VVI should buy. I mean, it's a company. The float in Wallenius Wilhelmsen today is also quite limited, right? Because you have the Swedish Wallenius family there. So between them, they own more than 2/3 of the company. So the float is quite limited. So it wouldn't really take that much to actually take it private from their side. But I mean, I don't think they will do that. But I think it would certainly possibly make their lives easier to avoid, market talk and opinions on cash flows, etc.
Any comments on China's car production, what it implies? I mean, it's been a huge driver, of course.
It's been the main driver, right? And if you go back 40 years and look at what Japan did, this can just continue. It looks like this is something they just decided that this is how we're gonna, take on the Western car industry. And of course, they're selling these cars much cheaper in China. So for them to handle tariffs, and the thing with Chinese car exports, I mean, there's a lot of focus on European tariffs, US tariffs. There's no Chinese EV going to the US. There's Chinese EVs going to Europe, but that's not the growth, right? That's not the target market anymore. I mean, it's been stalling essentially Chinese EV growth to Europe. So Chinese EVs, they're going everywhere else. They're going to Latin America. They're going to Southeast Asia. They're going to Sherm. They're going to go to Africa essentially. So. And that's important because basically the Chinese EVs are going to countries without any, domestic automotive industry. So it doesn't threaten, Brazil's automotive production because there is no in Brazil. So for them to have access, and I actually had that was an interesting conversation I had with an investor who was in Mexico, and he said, this was probably 2 years ago, why are these car carrier names trading? And this was when they were at even lower valuations. Why are they trading so low? What are the Norwegians, not seeing? And I told them, they don't really see the Chinese EV boom as sustainable because we sit here in Norway and we see that there's so many of them and they're unsold and they have their showrooms at Karl Johan, the main street, and no one is buying them. And the automotive journalists are saying they're bad quality. So and he said, okay, so that's it. Then I'm going to buy Höegh Autoliners because I sit in Mexico and I see how they love these relatively high quality, high tech EVs. That's great, and so Norway is not a good, predictor of where Chinese EV demand is going to be. So if that's the downside, then fine. And that was in a way a good conclusion.
Great point. So another segment where a lot of things have happened last couple of years: gas markets, LNG, LPG.
Wow.
What are we looking at here? Selective as well?
Yeah, selective. Very different, of course. LNG is a market that we've been. I mean, it's very hard not to be extremely bearish on LNG shipping, to be honest, because to me that looks what we've seen, what we had in 2022, is very much what we had in 2011. If you recall Fukushima back then, this was, I mean, LNG shipping, that's pipelines at sea. It's really, projects, you sell out your volume mostly. The US is changing this a bit, but historically you have an off-taker, you sell your volume for 20 years, you know where the cargo is going. And then what happened almost 15 years ago was that the Fukushima accident, tragic tsunami back then, shake things off a bit. So you suddenly had a spot market, which we didn't really have. Spot rates went sky high. You did 2-3 year time charters at stellar levels. People ordered a lot of vessels. Also for new projects, of course, coming, because the world saw, okay, we need more LNG. Projects were delayed, but eventually, when you have a $10 billion LNG export project, you're not going to rely on the spot market. You order the vessels. That's the only sensible thing to do. So that, of course, when people ordered vessels speculatively back then, projects were a bit delayed. Global natural gas prices were depressed, so you have no real trading margin to play around with. That market was dead, basically, until, you had another event in 2022 with natural gas prices surging on the back of Russia-Ukraine. So 2022 was a fantastic year for LNG shipping, and then we are again, speculative ordering, of course, again, project delays, with especially in the US. And then we are now in a market with an order book that is still 40% of the fleet, or even a little bit more, and the spot market that is just not responding to natural gas price spread or volatility anymore, which tells me that it's completely broken. It's just far too many vessels. So I think we probably need to scrap 100 or so older vessels. It's probably going to happen. And then let's see where we are 2, 3, 4 years from now. But the owners of good quality vessels will be fine 2, 3, 4 years down the road, but the ones without coverage at the moment, I think, will struggle until we have, a new black swan event, which can happen, and then things will change. But it just looks challenging to me.
If we talk about LNG and shipping, is Golar LNG the one that seems a bit interesting? I see some people speculating that this can have a very interesting journey ahead based on some contracts. Argentina is mentioned. Can you unpack what makes Golar a different company? I mean,
it's not. Golar shouldn't be covered by me. It's not a shipping company. It's different. And again.
But do people perceive that?
Yeah,
or
nah. It's a good point, because it's still covered by me, because I did that 15 years ago, 14 years ago. So it's not a shipping company at all. It's more like infrastructure FPSO provider with 2014, 15. So 2014. If you take the past 10 years, Golar's been through a full-blown energy crisis, the oil price crisis, which impacted natural gas. But they've managed very, very well. They built a flawless track. I mean, Hilli, the liquefaction ship. I remember again when they started talking about that in 2013. That wasn't when they started talking about it, but then it got a bit more specific. I read that FLNG vessels, they're lower risk than FPSOs, and my oil service guys, colleagues, they said you can't say that because it's not done, so it's not less risky, and I understand that. But what Golar is doing is they're taking pure methane and converting it to LNG. So they're not separating out condensates or NGLs or anything. They're taking essentially pipeline quality methane, liquefying it, And so it's like a very sophisticated freezer in a way. And what they've done with Hilli is impressive, because they haven't had a single day of downtime really. They've been managing flawlessly from day one. And of course their kind of value proposition is that they do that in a very cost efficient manner. And then making stranded gas resources available for those that want to buy them, essentially. And that has taken time. I mean, they're only now starting up their second unit, a decade after they really started investing in this. But from here on, yeah, you have the one in Argentina going to be the third, maybe another one in Argentina, so they're fourth. And now they have it rolling. I mean, now they can finance both dividends and growth from current operations, right? So they're not dependent on raising equity or raising a lot of debt to do this, or to grow the pipeline, so to say. But of course, I think at when the stock was 40, 45, then you were pricing in kind of 3, 4, 3.5 units. So of course, equity markets will be willing to do that when conditions in broader equity markets are good. When things are more shaky, then it's a little bit more uncertain, right? So. But it's a business model that I think, it's a business that I think 5 years from now, either they will have 3, 4, 5, 6 of these units, and they can start really harvesting dividends, or it's likely to end up, with a kind of a lower cost of capital player. So, build a pipeline big enough, and then someone else can buy them with a lower cost of capital, and then that will be a good event for Golar shareholders.
And then maybe the last point on gas markets, LPG.
Yeah.
I mean, we had one big transaction from Avance over to BV. Is that also going to be very selective going forward, or? Because that's a consolidating story, but
yeah. But if you think about it, I think BW actually, because the fleet has grown so quickly. I mean, again, Dorian, Avance, and BW, they all went public in 2013, early 2014. Back then, we had a fleet, I think, of just 150 vessels. Now we're at 400. So actually BWs, because they've sold a lot of vessels in recent years. So even when you add the Avance fleet, if you factor in the broader kind of fleet growth we've seen in the meantime, I'm not sure they have a bigger market share than they did. But it's more consolidated in dry bulk and tankers for sure. But they have basically 10% then of the total market, which is not massive. I think LPG is, if you look at underlying oil demand growth, it's petrochemicals, right? That's what's going to drive this. And you see what China is doing. China is exempting US LPG from sanctions. So they're trying to keep that away from this trade war, because they're completely dependent. 7 years ago, they weren't. US wasn't as a major. I mean, now they're 50-60% of the seaborne trade, right? So you can't really exclude US LPG. And that's where last year was a bit choppy, because you were suddenly hitting capacity at US export terminals, meaning that even though the ARB, buying LPG in the US, selling it in Japan or China or Korea, Taiwan, made a lot of sense, but it wasn't shipping, it was terminals that was the kind of bottleneck. That is likely to change second half this year into next year. So I think we'll see periods of fantastic VLGC rates. So I would buy BW LPG today.
Great. Okay, so a couple of segments to go. Dry bulk markets. I think the right place to start here is probably the Fredriksen deal, selling off Golden Ocean. Is the Fredriksen premium gone forever? What do you think about the deal? How can we unpack this? And is it a signal?
It's a touchy subject, right? But I think the price, if we start with the price is phenomenal. I mean, he's basically paying 25-30% premium to NAV, or the Savary, the three brothers are doing that. What they're getting for that is, of course, 40% of a great company, and a platform that they can use. And by use, that's where the broader equity markets are a little bit uncertain. How will they use the platform, right? How will they use the 60% minority shareholders? They paid a lot up front. They paid $1.2 billion for something that, as of yesterday, was worth 700. Of course, it's a big value drop. Is the Fredriksen premium gone? I think when a buyer like that comes along, and when it seemingly then strategically, financially makes sense for them to pay up like that, it's hard to kind of, and when they only want 40%, then okay, what can you do? I mean, had the price been 90% of NAV or NAV, so the premium, been versus market pricing had been kind of limited, then I would say, okay, why should you really do that? And you can say, okay, John Fredriksen, he's getting 80 million shares, maybe he's getting $3 more than he should, so that's 2.4, $240 million. Should he really risk his premium for $240 million? Maybe not. But I mean, at the same time, when you have a buyer like that, this is business in a way. But I mean, the point there is that what's going to happen to Golden Ocean? And there's a lot of talk, they need to consolidate Golden Ocean into CMB because they need to get their debt levels down. And let's see. I think it makes sense for them to not keep CMB Tech as this diversified, to me at least. I think CMB Tech would be better off as a holding company owning stakes in various subsidiaries, which you can have Golden Ocean become a Busimar or a Golden Busimar or something, where they can gradually drop their Newcastle Maxes into that company. Because if you take the 90 vessels Golden Ocean have, or if you take the Golden Ocean fleet plus the Newcastle Maxes they have, that's going to be a fantastic company eventually. And maybe you have to lower a little bit the dividend focus over the next year or so. The market will not like that. The market has clearly said that it doesn't like that. But if that ends up being the case, then Golden Ocean with a 40% CMB ownership and a 60% minority shareholder ownership, a dual listing Oslo, maybe even Brussels and New York, will be a very good, very interesting company 2-3 years down the line, because I think Newcastle Max prospects are very encouraging. But let's see. I think we just need to find out and hear more what their ambitions are, what they're kind of what are they going to do. And frankly, we don't really know. And of course, when you pay that type of money to get 40%, you must have a plan.
Is it possible to look at this deal without considering what happened with Euronav and Frontline, or should we separate these? Or is it just path dependent that this transaction happened, so this sort of open?
Who knows what type of fights they might have had in the background? I think this is a friendly transaction. This is no this is no quid pro quo, or what you say. But of course, we saw during that process that the Belgian family, they're not afraid of taking risks. They're not afraid of betting, huge. But of course, they know each other. They've done business in the past. So again, yeah.
But this is not a sign, from your perspective, to be bearish on dry bulk. And use that as a signal since John Fredriksen.
Not at all. I hear people say that, but of course the price he's getting is just, you're getting more than full price for something. He has PA exposure on dry bulk. He can buy 4.9% of every listed dry bulk company out there if he wants to. I'm sure he's doing it in some cases. So I don't think that's a sign of him being bearish. I think it's just, again, when you have someone that need the platform. And keep in mind that running a dry bulk company, I think it is a bit different from a tanker company. You have much more, a much greater variety in terms of commodities, in terms of ports. So of course the kind of whole operation of a company is more complicated, which then makes the value of the platform maybe a little bit higher. And And Golden Ocean is a great platform. So to get access to that might make sense. But of course, also what you're buying is access to 60% minority shareholder base, which also has a value. It's a high institutional ownership, so that you can use that platform to grow further, maybe fund yourself further, maybe, and then it just needs to be done in a way that is manageable and acceptable for those minorities.
Interesting. But then, if you're summarizing a bit, so Bell ships have sold. We had the Golden Ocean transaction. We have, of course, 2020 Bulkers, which has had a fantastic ride, and then we have Himalaya. So what are you foreseeing for this? And there are several other players as well, but is it selective the keyword here again, or are you positive on China demand markets, or is it?
I think people are way too afraid of China, or I think the analysis is too simple, because you just say that, okay, Chinese steel production looks unsustainable, so then Capesize demand is going to falter. When you look at what's actually happened, Chinese steel production hasn't grown for 5 years. Okay, they're exporting more, so domestic consumption is probably down. But what you're seeing is that they're still, investing in iron ore projects. They're still buying iron ore. They're still keeping iron ore stocks high. And what's happening is that domestic production is falling. And this is, again, going back to, I had a colleague of mine 10 years ago who covered Northern Resources, the iron ore producer up in northern Sweden. It wasn't a good story, but I very much remember his slides on how China, the marginal iron ore producer with the highest cost curve, that's the Chinese guys. So of course it makes sense to reduce their domestic production and keep importing higher quality goods from abroad. And that's what they're doing. And that is why I think the Capesize market can do very well, even in a scenario where Chinese steel production starts falling. Weaker margins also mean that you want higher quality iron ore, because then you need to buy less coal to mix it up with. So and then when you look at the 2026, 2027 expansions that are coming, not only in West Africa, also other places, when you look at what China is doing in buying a lot of this second-hand tonnage, to me that doesn't look like a Capesize market that is going to falter and China's going to stop buying. So I think 2026, 2027. I must admit I was a bit afraid as well in December, January, because the Capesize market fell so brutally. I didn't really understand why. I couldn't really see why the Cape market should be so weak, and I didn't really see why 2025 would be so much weaker than 2024, which is why I stuck to. I thought 2020 Bulkers was a top pick for this year going into the year, because I just didn't understand why. And then luckily that's reversed a bit now, so rates are firmer and they're locking up vessels at good rates. But the smaller vessels, it's more complicated. Higher fleet growth, easier to order, right? So there you have this when you think about all the Greeks that had 6 Panamaxes in their family fleet, through, which was a good thing through 2021, 22. So they made a lot of money, order a few more, and that's where we are. So of course we're going to look at fleet growth that is going to be heavier for the smaller vessels, but scrapping is also picking up. It's interesting to look, if you look through the latest Golden Ocean report and see what they're reporting in terms of costs on dry docks. Dry dockings are much more costly than they were. So of course taking a 22-year-old Panamax, paying $3-4 million for that versus scrapping it and buying someone. So I think we'll see a lot of scrapping. And of course you have this whole rebuild Ukraine, rebuild Gaza. Let's hope that's going to happen. That is going to be a boost to smaller dry bulk demand. It's going to require cement. It's going to require steel products to be moved into new areas. So I think it's very easy to just look at China and saying, okay, China has peaked. China's going to stop growing, sell dry bulk. It's more complicated than that.
Do you like some of the mining companies, or is that totally different to analyze and look at? Because I've seen some interesting actions in the big players, and of course they are a bit unique in how they plan, how they work, but do you see any signs there that is interesting that also gives signs onto the shipping markets as well?
Yeah, I mean, you can look at what's happening on European industrials now, and kind of investing in defense, boosting. So of course, in the end, that is also going to help steel demand and iron ore, demand. This whole how the Western world is taking a step back from this ESG push. Certainly not gonna hurt the coal story further. So maybe the coal producers are interesting again. That's of course, it's dangerous turf. You have to know what you're doing when you start investing in those companies, because it's very, very volatile, and it's not unheard of. EV/EBITDA 2 is not always cheap, even in those type of companies. But I think definitely there are some interesting underlying trends here.
Okay, so the last segment before we dive into some other topics as well. I think we could have probably spent 1 hour on each segment, but we'll try to get over to the tanker markets. So yeah, what are sort of the most interesting stories? The sentiment has been yelled about almost how good it's going to be, and then it has collapsed a bit, but then depending on the time frame you have, and should we start with crude and the pure tanker companies?
Yeah, because I mean the crude names, they have at least the VLCCs. Interestingly, the VLCC names are the ones that have held up the best. Frontline is down a lot, but if you look at DHT, and some of these names and the valuations they have, at the moment. That's because we're still waiting for these this maximum Iran pressure to have an impact. And of course, looking at crude tanker volumes, crude tanker demand hasn't really been growing for the past years. It's been flattish. And of course, why is that? It's partly because Iran exports have gone up. So that has taken kind of all the increase, but it's also probably a little bit a structural thing. You have seen, again, go back to a Torm presentation from 2005, and you will see a slide on how refineries built closer to the oil producers is going to lead to more demand for product tankers than crude. Go back to a Scorpio slide from 2012, you see the same thing. Go back to any equity research slide from the past decade, you see the same thing, and that has happened a bit. Clean tanker demand has grown more than crude for the past 5-6 years. But the supply situation is extremely interesting in crude. The fleet is old, the number of vessels not turning 20. The 20-year-olds are worth twice the scrap value. They're never going to be scrapped. But 25-year-olds, I don't think 25-year-old vessels are going to be around. And just the number of vessels now hitting that 25-year-old mark, that number is going to go higher. So of course, I think the point is scrapping is never good for shipping equities, because you only have scrapping when rates are at OPEX, and you don't want to own shares into rates at OPEX. But now I think you'll see scrapping without rates at OPEX. That's the point. And then you have a very modest delivery schedule for VLCCs, at least for another year or so. But again, it's dependent on Iran. We're waiting eagerly to see signs of Iran exports falling. I think now we're seeing an interesting, maybe the opposite is happening. Maybe Iran export won't go down, but maybe Chinese buyers will just start procuring or buying second-hand vessels to replace the ones that have been sanctioned. There's a rumor out now that DHT, for example, have sold 2 VLCCs, maybe to a Chinese buyer. Tsakos has sold a Suezmax to a Chinese buyer, getting very good prices. And of course, the thing is that especially the January 10th sanctions from Biden on vessels that had carried Suezmaxes and Aframaxes that had carried Russian crude above the price cap, those vessels have been taken out. They're not really operating anymore. So you need to replace them. And if that happens, if you don't really get the Iran volumes down, but you get the kind of Western fleet, untainted fleet down, then it's going to help the broader market. Suezmax rates now, super firm, right? The Black Sea, for those that are willing to go into the Black Sea and do CPC cargoes, you can probably make $65,000 a day, the highest since late 2023, really. Aframax rates are firm. So yeah, I think there's certainly reasons to be optimistic, but again, that can also change tomorrow. Maybe tomorrow Trump says, okay, all those 100 vessels that were sanctioned, you're free to trade. And then, sentiment will collapse and things will move back down again.
Is it a true statement that it is almost impossible to predict, peak demand? I think it was Magnus Halvorsen said in an episode that if you look at all of those, super cycles or that peak was extremely high, no one predicted it because it's too complicated to truly understand.
Yeah.
So that's why to go around, expecting that, you shouldn't really do it, because when you look at it, I think LPG had some of the same story a couple of years ago that very few predicted it, but it just happened. Is that sort of like a true statement?
Yeah, because it's really, there's a lot of, I tend to not focus on ton miles in shipping, trying to predict ton miles, because there's so many things that impact rates and demand that you can't factor into an analysis. And the Red Sea is a good example for tankers. The Red Sea, the desktop analysis is that the Red Sea, effective closure has boosted product tanker demand by a lot because the cargoes are going around the Cape of Good Hope instead. And that might be so, but rates were much softer from after the frenzy kind of calmed down. Rates were much softer, and what happened was essentially that because rates were high, because the cost of shipping went higher, the trade just died a bit. Refining margins died. So it's in a way to predict demand in shipping is an analysis with so many unknowns that it's just because higher rates will mean lower something else, lower margins for a trader. Maybe he will stop doing that and doing this instead, and then that will lead to lower demand. It's really difficult. So I think there you just need to look at some KPIs. You just need to track. You need to see, of course, is your client, is the customer making a lot of money? That's always a good thing in shipping. If the customer makes a lot of money, if he thrives on volatility, on super margins, etc., that's good for shipping because he will just pay up a little bit, like the liner guys are doing today in feeder, to feeder owners. So predicting. You can look at some structural changes. You can look at kind of, okay, this long-term story of US exports, but then suddenly China is not buying US crude anymore because of tariffs, and then that goes around, and it's really difficult.
Yeah. So taking a segue to fundamentals, for people tuning in that want to know how to value a shipping company and a shipping stock, can you, from sort of first principle, lay the foundation for people how to go about it? If you had to teach someone, if you had a new employee at Pareto.
No, of course. I mean, okay, where should we start? I mean, it's to model a shipping company is easy. When I have interns that are, I'm sure, very, smart young guys, I'm sure they're super disappointed by the shipping models because they're, not that many lines. It's very easy. Rate times number of vessels times number of days, and then you essentially get there. So to do estimates, of course, in shipping is easy. To value a shipping company, of course, you have the NAV approach. I think NAV approach today, especially in tankers, is a bit useless because you don't really know, and the market just cares about the direction, and the direction for tanker values is probably still down because there's a lot of newbuilds coming, there's a lot of uncertainty. So whether the NAV in Hafnia is 75 or 65 or 85. You need to have NAV is better on a relative basis to see who's kind of priced at a bigger discount to its peer and who's priced at the premium, and does that make sense? Is there a reason why this company should be priced at the premium? If so, how big should that premium be, etc. In times like these, I try to think about implied pricing. So I try to look at, okay, if you buy Hafnia, how much are you paying for a 5-year-old MR? If you buy Frontline, how much are you paying for a 5-year-old VLCC? And of course, in Hafnia today, for example, if you take that one specifically, you're basically paying $27 million for a 5-year-old MR. That's basically in line with the trough level of 2021. It's far below newbuild parity. It's far below what brokers are saying you can sell a vessel for. DS Norden is rumored to have sold a 10-year-old for $33 million, so it appears cheap. But that's more for the value guy, right? That's more for the long-term value investor who say, okay, if I pay $27 million for an MR in Hafnia, it may take 6 months, 12 months, 18 months, 24 months. But over time, I think that's going to be a good investment. And I don't care if it ends up, hitting $25 million per 5-year-old MR before it goes back to 35. So it doesn't really work for the more kind of indexed linked or index focused asset manager, because he needs to look at the investment universe and say, okay, what do I believe will outperform the market over the next 6 months and what will not outperform the market? And of course there you have this estimate momentum, which has become a very, very almost a bit frustrating in shipping, because you have a situation where, okay, spot rates fall and then share prices will fall, and then some start to update their estimates, which you do, but you can't do it every month. And then share prices will fall, and the company will report, and they will come in below the average estimate because not all have updated estimates. And then they will give guidance for the next quarter and it will be below. And so that's the challenge now, that there's a lot of focus on estimate momentum rather than kind of valuation. And that tells us that just the market is so uncertain. They're not daring to look 2-3 years down. And I understand that, because you're coming from very, very high solid markets. So we probably need to get a little bit more clarity, and that's why I think for tanker equities in particular, it would be just good to have a situation of stability and just know what we're facing. But no, valuation in shipping is simple. It's very easy.
So to put it maybe a bit more bluntly, you shouldn't be sort of maybe a value investor in shipping, because the nature of shipping is cyclical. So you can't really just...
yeah, I'm not sure. I'm not sure I agree in that. Okay. Because shipping can be value. At times shipping is deep value.
Yeah.
But of course, if you're buying stuff at far above replacement cost, and that replacement cost is now 25-30% higher than the average it has been long term, and you're making 35% free cash flow yields, it tells us then it's not value. But if you're buying stuff that doesn't make money at 50% discount to replacement cost, it can be deep value. So I think some of the shipping names are into the deep value category now. They weren't a year ago, but they are now.
What is your favorite question to ask management of shipping companies?
Wow, that's a good one. I mean, I have the good thing about being part of this public shipping universe is that you spend a lot of time with management. I WhatsApp them, I talk to them frequently. So of course, the number one question, I mean, I don't think there's any good, because I have such a constant dialogue with them. It's just, but of course, when you meet someone new, and I think it's good to have an understanding of how of course, how are you intending to use your business to create value for shareholders? What's your thinking? When do you invest? When do you not invest? What do you do with your cash? And this is more, this is the number one question for investors. If you just look at an overview to try to understand what the strategy of the company is. Are you holding back cash to invest? Can make sense, but it's not necessarily what the market liked. And why are you doing that? I think I'm very much against the kind of, in my opinion, a little bit simplified notion that as soon as you trade below NAV, you shouldn't be allowed to invest. You should just buy back your own shares. To me, that's far too desktop simplified analysis. And then, so the buyback versus dividend discussion is, of course, always an interesting topic to kind of hear the perspectives of managements, even though they're not necessarily the ones making the decision. Shipping is a very, very commoditized business, so it's hard to kind of distinguish yourself in the spot market. But from where I sit, it's always important to try to understand what the motive of management is, what do they intend to do with their company, and how are investors, what should investors expect? again, there's nothing wrong with holding back cash if you just say that's what I'm going to do. You will probably not get the premium pricing, but who can complain? You know, if you tell the market, I'm not going to buy back stock, I'm not going to pay dividends, and then you do exactly that, then how can people be unhappy with that? I think, again, that should be the number one question investors ask. How are management spending cash flows?
Yeah, I think that's a very good one. So we have a lot of young people tuning in, probably want to have a great career in Pareto or an investment bank or something like that. I know that it requires a lot of work. Can you share some reflections if this is the career path to go into? What should be the consideration? Should you really love it? Because you shouldn't expect coming into Pareto counting hours and getting overtime, or
yeah, no, you must. I mean, of course, and there are two ways of becoming an equity analyst. You know, it's either because you have a deep understanding and interest in equity markets, and a lot of people have that background. You know, they've been investing in the public market since they were 12. They read Warren Buffett books, etc. And those are and that's a great background to have. And I love recruiting those guys because they're so clever. They know so much. And then you have other. I was probably not in that basket when I studied literature and journalism. Then I went to NHH, so the Handelshøyskolen in Bergen. I didn't think about applying for the Børs Club at the time. If I had, I certainly wouldn't have been accepted. I gradually got into this, and I ended up in Pareto by coincidence. I was going to start working in Boston Consulting Group, and I had dinner with the guy who was head of research, and he told me, you should think about this and this in investment banking or in equity research. And that what he said appealed to me a little bit, like as in finance and equity research, it's perhaps the only job where you can actually, after 6 months or 9 months, you can actually call up a CEO, depending a little bit on the company. But you can call up a CEO, and he will actually care to give you a good answer. He will care because he wants you to understand, his message. He wants you to convey that message to shareholders. So you can actually get some attention there. And of course, maybe the biggest, what I was told then in advance, my thinking was that equity research was just about, sitting in a dark room, thinking clever thoughts in Excel, which I like to do. I love doing that in the evening in my home office, digging deep in Excel in a quiet room. But it's also a lot about talking to people and trying to, find some new information and talking to someone who makes you a little bit smarter, and then you talk to another one who makes you even smarter, and then and that's how you kind of excel. So you should be interested in people also, if you want to have a career like this, because you need to have something to say. You need to have an analysis. You need to have something. Your numbers need to be correct. So you need to know maths. But of course, everyone do. That applies. You need to think fairly quickly, I would say, because you're often put on the spot. But you need to be interested in talking to people. And maybe shipping is a bit special there, because it's a people business. It's a people business, yeah. So it's a business where it's essentially, it's a little bit old school in a way. Yeah.
How can you sustain, the pressure and the hours and the peaks that you will get as an analyst? Is that just something you need to figure out?
Or you become damaged. So you become hooked. And I think you need to be willing to become hooked to do a good job, because you need to understand that. And again, shipping is special there because, my day isn't over until the US equity markets are closed. So So now when they're only 5 hours after us, it's good because then at least at 9 p.m. I can relax a little bit more. So you need to be available and ready at all times. When 15 minutes past 10 in the evening, when there's a statement from Golden Ocean that John Fredriksen has sold 40% of the company to the Belgian guys, you need to be built in a way that, I mean, then I lie awake thinking and, you know, wondering all night, and then I get up at 5:30 to write something to clients about the thoughts I then have. And I think you need to be built a little. I'm exaggerating, of course, but you need to be built a little bit like that because, yeah, your clients are counting on you for information, so they want you to be interested and be involved. And of course, they are probably much better often to predict share prices and share price reactions than I am. But yeah, they need to know that at least they're talking to someone who is devoted. So yeah, when you begin in Pareto as a young analyst, you should expect working from early morning to late night. And but if you do that, then it's a lot of fun, right? And of course, you can't do it forever, even though, yeah, some do.
But if a shipping company gives you a call and says it's time to get you inside, helping us build this shipping company, is the answer always no?
No, probably not. It has been so far, but at some point maybe. But I'm kind of I think I'm also an equity markets guy, right? So it's not I like both, and that's why this role suits me.
So just a couple of more quick fire questions. Which shipping companies or CEOs do you look at and say, okay, that's a remarkable job the latest couple of years or something like that?
No, I think there's a couple that stand out, and of course it's hard to kind of underpin the role that, and I've seen you've had a couple of these guys in your podcast as well. It's hard to not highlight, Kalle Klev, Øystein, what he's done with Avance, what he's done with Flex LNG. Created a lot of value for his shareholders by, clever financing agreements, chartering out vessels at the right time, selling at the right time, and that's created a lot of value for those that have been kind of following him. I think one, which is, if you take DHT, the way they built up that company with a clear kind of brand and all VLCC fleet, raised equity at the right times, sold at the right times, chartered out at the right times. And by doing that, they've actually, Svein is created, and Trygve earlier, but Svein now has created a company that is in fantastic shape and trading at the premium. So you have a US listed company trading at solid premiums to peers in a great shape. That's the way you build kind of a business and are able to. I think Hafnia is a company I love, and I know them from 2013. So they also, I mean, if you think about how they managed the cycle, they bought Oaktree's chemical tanker fleet, they bought Scorpio's LR1s, just before the market took off. And then they just extracted value ever since. They paid out dividends. They've not really been rewarded in the equity markets recently, but those that bought in on the IPO have made a very good return. So there are ways you can, create value. Take BW LPG since their IPO. I think they've generated 15% annual return, which is quite good. So a lot of people are saying, I was told, I remember one fund manager here in Oslo told me at the dinner some 7-8 years ago that, Eirik, you're a clever guy, you can't cover shipping. It's not, that's not going anywhere. And all the companies are just, moving along with the cycle. And to a certain extent, yes, that's true. You can't really, you can't trade, well when you're, even if you have all your vessels locked up, you're going to suffer when the cycle turns. But you can over time create a lot of value by buying at the right time, selling at the right time. And the equity markets, they appreciate that. You can't measure that over a 1 or 2 year time span. You need to look at 5, 7, 8, 9, 10 years.
Very true. So another one, will Oslo lose its place as the best place to list a shipping company? I mean, there's many things here. It's regulation, it's a weak currency. There's many factors at play, but if you're being a bit brutal, is Oslo losing a bit of its momentum in attracting shipping companies when they can go to US or?
No, I don't think so at all. I think you just have to look at where we are in the cycle. So the next upcycle, when the next upcycle begins, if you have a small fleet of tankers and you're going to raise some equity to buy some more tankers, you're not going to do that by listing in New York. And why? Is because it's going to take you much more time, and you're not going to get the investors on board. Here in Oslo, you have all the knowledge, you have the family offices, you have the best institutional asset managers that really understand shipping cycles, and they know that buying stuff when rates are weak, but with a positive supply outlook, they know that that's going to turn. So I think the investor base, it varies a little bit, with the cycles, right? But I think definitely you'll see Oslo as the number one initial listing hotspot. So yes, if you're Flex LNG, it makes perfect sense to delist and go to New York because you're trading on a dividend yield and you're not going to raise equity ever again. But no, Oslo is going to be on they're going to be the the trailblazer, and then New York is where you kind of do your secondary listing to buy into the bigger, broader, massive investor market once you have reached that scale. But if you think about what an IPO is for, it's to raise capital for growth mostly, unless you're a private equity company that just want to sell, not involved in shipping. So if you want to use an IPO to build up a franchise or a business within shipping, you're going to Oslo, you're not going to New York.
That's good to hear. Last one, any favorite books you can recommend the audience that they have to read? You know what,
that's I try not to read. I shouldn't say this. I don't try not to read, but I read fiction. I don't read the finance books, etc. I never have, because as I said, I study literature. I like to read other fiction books. So
but recommend some of those then, so people can tune in, because other people also have recommended fiction books.
Okay, then I would read the one I'm reading now, which I read often, is Väinö Linna's Unknown Soldier. It's a Finnish from the war against Russia. Very kind of it's very how do you say, it's something you should read these days. It's from the Winter War. So Väinö Linna, Unknown Soldier. You can read, one I read again for the probably fifth time is Crime and Punishment by Dostoevsky, also very interesting. And I like there to it sounds a bit pretentious to recommend Dostoevsky. So
it's fine.
No, but Unknown Soldier, one I think everyone that listens to this should read. There's also a good Netflix show there, or series.
Good.
Now you surprised me. I mean, I hate being put on the spot like that. But I often ask this question in an interview when I interview younger students, and it's very good to read. It's something that makes you more interesting as a person, and it's good to just think about something completely different.
Makes perfect sense. Okay, Eirik, let's wrap up there. Thank you so much for taking the time. It was a joy talking to you, and hope we can do it again in the future.
Likewise. Thank you.